Hi, everyone. We're going to get started in just another minute as more people dial into the webinar. Good afternoon, everyone. Thank you for joining us today. My name is Chris King, Chief Development Officer for Salamander Hotels and Resorts. I'd like to welcome you to the Northeast chapter of the International Luxury Hotel Association's webinar on market recovery trends, moderated by Mark Woodworth, Principal, Woodworth and Associates, with panelists Jan Freitag, Senior Vice President of STR, Cindy Estes Green, co-founder and CEO of Calibri Labs, and Jamie Lane, Senior Director, Economics and Forecasting of CBRE. Today's webinar is brought to you by TSF Natural Home by the Futon Shop. I'd like to introduce you to Suzanne Diamond, who will briefly talk about how their product can assist hotels in the current travel landscape.
Thank you. Hello, I'm Suzanne Diamond, the CEO of TSF Natural Home, a 40-year-old retailer and private label manufacturer company based in the heart of San Francisco with operations throughout California and Mexico. Slide, please. Thank you for the opportunity to introduce our company with our cutting-edge copper technology to support you in creating a safe and secure environment, attracting travelers back to your properties, as well as protecting your housekeeping and hotel staff. Slide, please. There are options in antibacterial and antimicrobial finishes that can be added to most fabrics, such as copper or silver. These are helpful in the short term, but the finishes wash out in time, usually 15 to 30 wash cycles. Our patented lab-tested technology infuses copper permanently into cotton, poly, or tencel yarns, creating an antiviral smart fiber. Slide, please. Copper is known to kill virus and bacteria on contact. Our technology embeds the copper particles naturally without chemicals into our luxury yarns using only water and sound waves. This creates a permanent bond between the copper particles and the fiber, which won't abrade or wash out. We chose copper, which kills microbes, over silver, which traps microbes, as silver works when wet and copper works wet or dry. Slide, please. Protecting your investment long-term by keeping your bedding non-toxic and free from pests and contaminants. Our Nelson Lab-tested, GOTS-certified organic cotton barrier fabric has the tightest weave commercially available. The pore size between the warp and the weft of our fabric is under 2.5 microns. A dust mite, invisible to the eye, has a micron circumference of 10. A COVID virus surrounded by a moisture droplet has a micron size of 3.5. Our barrier fabric is both waterproof and washable. It protects both your furniture as well as your guests from unseen organisms. Slide. Whether you're offering work from hotel or family vacation packages, you can set your property apart with non-toxic furniture with protective smart copper and barrier fabrics. Our sofas and modular units for lobbies and guest rooms can be modern or traditional, organic or natural, and are designed with washable and removable slip covers and protective fabrics. Looking towards the future in a post-pandemic world, family and travelers want to deserve comfort, safety, and assurance where they sit and sleep does not contain any hidden dangers. In-room sofa beds and twin full and queen are petrochemical free, designed for comfort and support, featuring natural latex, plant-based fibers, and coconut core, with a pop-up ottoman makes this a breeze to convert and can be designed using our smart copper threads and barrier fabrics in any textile pattern you require. Slide. Our luxury mattresses are made with the same natural and certified ingredients and can be crafted in whatever specs you need. We can encase the mattress cores with quilted ticking infused with our copper thread. All mattresses can be unzipped and the contents replaced when needed. Slide. Protecting your furniture, mattress, pillows for guests and housekeepers will be the new norm in today's world. Investing in our copper and barrier technology with a natural flare can reduce exposure and spread of microbes. It is incredibly important for the housekeeping staff to keep them safe while changing the bed linens during and after the guest stay. Slide, please. Face masks can cause skin irritation, especially in hot and muggy conditions. Our silk and organic cotton masks offer comfort, breathability, and optimal protection. The CDC says this combination of materials work almost as great as an N95, filtering out the virus. Leave your mark with your hotel custom logo or colors designed on our silk, copper, or organic barrier face masks. Show your guests you care with a special gift at check-in. Copper-infused traveler pillows and face masks are practical and necessary for guests to use during and after their stay. This simple gift will go a long way in building trust and security for your guests. We understand the enormous obstacles in reopening plans, and we're here to help. Thank you for your time today, and please feel free to reach out to me for more information or download our notes available on this broadcast. Thank you.
Okay, Chris and company, I guess it's over to me. So again, I'd like to, Chris, thank you, and thanks the leadership of ILHA for the opportunity to spend some time with you this afternoon. We're very fortunate in that we've got a terrific panel lined up that are going to make a good dent in the long list of questions that many of you sent in ahead of time while you're registered. So I want to thank you to that. I will say that there hopefully there's going to be some time at the end of the session that we can answer any questions that our panelists don't cover in the context of their remarks. I think they're going to get most of them. I think you're going to be particularly interested in that someone did send a question in that they wanted to know the formula for the vaccine for the COVID-19 virus. And Jan Freitag actually has the answer to that one. So listen closely when Jan's speaking, because he'll share that with you. I think I'm correct.
Gin and tonic?
Right, Jan?
Is it not just gin and tonic?
That's stage one, and then there's more after that. But
I'm on that.
That's good. Okay, good. Hey, so anyway, again, let's get started, because we've got three terrific panelists that have some very interesting and importantly on-point insights as we approach the end of year one of the pandemic and critically getting into 2021. So with that, Jamie, I'm gonna turn it over to you. Let me see if I can advance it correctly. And I'd really like you to set the stage give us some perspective on where we've been, where we are, and critically where we're going in the year ahead in the context of the economy in the near to midterm outlook. And so I'm going to turn it over to you. I must say I looked at your title slide, and winter is coming. I can read that more than one way, but I'll have you tell us which way we should interpret that, and then we'll take it from there. When you're ready for me to advance the slide, just say so, and I'll move it forward. So Jamie Lane, over to you.
Thanks, Mark. And if you could just hit display settings and change your screens while I get started, that'd be great. So the title of my presentation is Winter is Coming, and it is more than a famous Game of Thrones line, but also a nod to the seasonal changes coming for the industry. And the weather, and here in Atlanta, we're experiencing today a bit cool. And a key assumption in our outlook is a vaccine by Q2 2021 being widely distributed. That is and penciled in. And until then, the industry will continue to face extremely challenging period as we come off peak summer travel and fall and winter settles in. And really, even once we get a vaccine, we may still see a broad-based economic recession that will take us years to pull out of. Next slide. I've started really every single presentation since March with a look at the COVID case counts. And here we see it by region, daily new cases over the past 6 months. Because the virus really led to the shutdowns of the economy and contributed to this fear of travel that's impacting us so much. So controlling the virus and a treatment will be key to alleviating the fear to travel and bringing guests back to our hotels. We are seeing significant declines throughout the South and West, resurgence somewhat in the Midwest, and also key to our assumptions is that case counts will decrease throughout winter and we won't see a second wave. On balance, though, our outlook hasn't changed much since April, with better performance in late Q2, Q3, as the economies and travelers largely ventured out of their homes a bit earlier than we expected. And that led to better industry performance growth. With the resurgence of the virus in June, July, we now expect a weaker performance in Q4 as it's really delayed all of our returns to the office and return to corporate travel. So on balance, we're sort of on par for 2020, but a bit weaker in our outlook for 2021. And the next slide talks to some of that. So looking at the overall economy, we've seen 22 million jobs lost in April. We've recovered 10.5 million since then, and over 4 million of those directly related to leisure and hospitality. On the next slide, we look directly into those leisure and hospitality jobs. In accommodations, hotel industry, and outside of the bump we saw in June, we've seen essentially no gains in jobs since then. And we're down still significantly from 2019 levels. The slow recovery broadly in leisure and hospitality is in direct contrast to the really significant recovery we've seen in consumer spending. So stock market is at or near records, and savings rate is through the roof. And that consumer spending is going on home sales, car sales, grocery, liquor sales, so durable and non-durable goods, and it's not flowing through yet into the services industry. The next slide shows really where we've seen that weakness, and we can just skip this slide. And it's, I'm sure you'll see it in Jan and Cindy's data of a pretty decent recovery in drive-to traffic, where through August, you're down like 15% over 2019 levels. And this data comes from Arrivalist on trips away from home greater than 50 miles by road. And you contrast that to the air traffic, which is still down roughly 70%. And when you dive into the air traffic data, and it's significantly higher on the weekend than weekday, which suggests even that is leisure travel. So not much recovery, and I'm sure both Cindy and Jan will talk about the recovery on corporate hotel travel. On the next slide, and I think this is my last slide before I'll pass it back, is just, and what is the letter we're seeing for the recovery? Is it V, U, W? A lot of people recently have been saying K. I would say for the lodging industry, it's a lowercase k. So it's various shades of bad, and it's not going to be for another couple years before we get into positive territory and start or see a strong recovery started. So with that, I'll pass it back to you, Mark.
Okay, thank you, Jamie. And Jan, you're up next. I think I could be shocked if everybody on the call wasn't fully aware that STR tracks data across the globe. With that ability, Jan, I think it might be helpful for the group to maybe benchmark, what's been happening here in the States against some other parts around the world. So if you take a minute and speak to that, I'd be looking forward to hearing what you have to say.
Okay, great, and thank you very much for having me. I appreciate to be with you today. I think we should rename this this webcast the way Jamie said it, various shades of bad. That's pretty much the tenor from the data that we have access to. The only quote unquote silver lining is when you look at China. This is tracking the occupancy for just luxury class hotels. What's very interesting that we're going from a single digit occupancy in mid-February to now 61% or so. So over 60% without a vaccine. Now, you can't really equate China to a lot of other countries. Obviously, they can lock you down. There are very clear tracing mechanisms in place, but it's just helpful to see that indeed the hotel industry can make it through this without a vaccine and without large-scale testing. What you're seeing on the far right-hand side here also is we're looking at Europe, we're looking at the United States, and that in Europe, unfortunately, it was a lost summer. There really was no demand for high-end properties to speak of. I mean, the occupancy is in the mid-30s, and that includes a lot of properties that actually never opened. You know, so there are the denominator is much smaller than it used to be. And then you're looking here for the United States also that we're kind of, I don't want to say stalling necessarily, but you're not seeing an upward trajectory the way we had seen it through the starting of the week of April the 11th, which was the lowest week that we'd ever recorded. On the next slide, then we're tracking room rates. And that is indeed, you know, various shades of bad. The Europe data here is a little bit better just because the sample size is so contracted. But you're seeing that overall room rates in local currency indexed to February 1st are still very much lower. And again, and in February, you know, I'm not sure that that's really a great baseline to take off, you know, because that's already sort of a slow season anyways. You know, so we're much below a baseline that was already lower. And you're seeing here that in China, there's not a lot of signs of life. In the US, basically the same thing that we're seeing. Yes, there are some people traveling, but the traditional, you know, high-end incentive travel is basically gone. There are no groups to speak of. So this is mostly individual transient. Next slide, I think.
Yeah, actually, before we do that, Jan and Jamie, and then obviously Cindy, chime in if you'd like to. But as I recall, not long after this pandemic began, both of your firms, you were watching closely at what was happening in China and benchmarking U.S. behavior against that. And for a while, it's been some time since I looked at it, but I mean, should we expect the U.S. to follow the path that we're seeing carved out in China, or no?
Full credit here to Jamie. That was his idea. You know, he emailed me and said, "Hey, I made this chart. What do you think of it?" I'm like, "Oh my God, this is brilliant." You know, and so I totally stole it. So that was all Jamie's thought work. But the point was, yeah, it looked like that China was quote unquote only 8 weeks or then 7 weeks ahead of the U.S. You know, and that relationship held until it didn't, you know, so that currently that relationship is broken. I'm not using that chart anymore, Jamie, no offense, you know, because the China data is, for the lack of a better term, back to normal, and the US is clearly not.
Yeah, and what broke the relationship was the case numbers. So China was able to get the COVID situation broadly under the control. The US wasn't, and that sort of broke the relationship. And it points, and not that the U.S. probably could have gone into extreme lockdown mode that China did, but if it would have, then we would have been able to suppress the virus right away. And it's maybe a what could have been, but nowhere really outside of China has been able to been that successful.
Got it. Okay, well, thank you both for that. Cindy, your firm has the unique ability to quantify exactly what the customer is paying for a room and what's coming in over the front desk at the hotel. So I'm very interested to get your updated thinking with respect to what you're seeing trends in that area and shed some light on that for us.
Sure. So I'm going to speak to our baseline reference year of 2019 for a few slides, and later in the presentation I'll get into how all of this is playing out in 2020 and specifically for the luxury segment. But just to set the stage, when we look at revenue, it comes in several shades or flavors. There's what the guest actually pays, and then it's what the hotel actually keeps. And the gap between that can be rather large, and it's usually made up in what is normally known as cost of acquisition, which for our industry at every chain scale and every segment is a growing number. So when we look at 2019, in the US market, and this is all US data that we're looking at, the guests actually paid $173.2 billion across the whole industry in the US, from economy all the way to luxury. The hotels spent about $4 billion in wholesale commissions, which brings us down to what we call hotel collected revenue, which is the revenue that the hotels report, because they don't report what the guests paid in terms of wholesale commissions. The third-party wholesalers collect that, and it never shows up on the P&L of the hotels. So the hotel collected revenue for 2019 was 169.3. So that reflects the $4 billion difference in wholesale commissions. We then take that number and say, well, how much was paid in retail commissions? For the whole luxury contingent, there's a fair amount of amenity costs to luxury consortia. There's loyalty costs for the branded hotels, and there's channel and transaction fees. Across the US, that was about $10 billion last year. So that brings us from the 169.3 in hotel collected to what we call COPE revenue, and that's an acronym for contribution to operating profit and expense. So it's a net revenue number, net of direct booking costs. And that for the US was another 10 billion. So between the wholesale commissions, the retail, the loyalty cost, amenity costs, $14 billion. We then take away sales and marketing cost, which in 2019 was about 15 billion, which brings us down to what we call net revenue. So that means that while the guests paid in total 173.2, the hotels actually collected or kept 144.2. So total 29 billion. We have, and Mark, if you want to just progress, there's a build here. We call that revenue capture, which is what do the hotels keep of what the guests pay? Kind of a simple question, but something that isn't normally tracked, and we're starting to keep close tabs on that. Last year in the US, the number was 83.2. The previous year, the number was 83.5. So the US lost 29 basis points in terms of the revenue it was able to hold on to because the acquisition cost numbers were going up. So if we want to look at that, and if we go to the next slide, we'll see that if we track the Revpar numbers, they grew well, and obviously this year is going to be a big change, but just pattern of the last 5 years. We have lost between 25 and 40 basis points each year in revenue capture, meaning we're just paying more money to get our customers. The revenue capture number has dropped every single year, and this year it's the 83.25, as you saw. So 2020 is going to bring lower revenue and same or higher costs. So in terms of cost of acquisition, it's an issue that is critical to pay attention to. And if we want to kind of unpack it and say, well, what was really growing and where did the costs actually come from? If we go to the next slide, we'll see a 5-year pattern of, growth. And Mark, if you progress, I think there's some, you'll see that guest paid revenue since 2015 had a reasonably healthy growth. This is what the guest paid, including the wholesale commissions, about a 17% growth if we index from 2015. Retail commissions, which is like what you pay to a traditional travel agent, and amenity costs, which is part of that, grew slightly faster than that. For those in the branded community, the loyalty cost grew, but it grew about at the same rate as guest paid revenue. Channel costs were actually a little lower. The big increase, not a surprise probably to anyone, is the OTA commissions grew at a much faster rate than guest paid revenue, actually more than twice the rate of growth. So it's not so much that it's, the OTA is the big bad wolf. It's really all third parties, because eventually it'll be Google and potentially Amazon and some of the others that will take that business over. But it's really a question of third party versus direct business. And it's always been a challenge for us since the digital marketplace became so important. It's been a challenge for hotels to try to get as much direct business as they can. The direct business runs about twice as profitable. And that runs from economy up to luxury. That number still holds, about twice as profitable as third-party business. But there's always the question of what faucets are running in any market at any time. And when I show you some of the 2020 data, you'll see that the mix of business has changed pretty dramatically in terms of which rate categories, which market segments are actually growing, which ones are not growing, which ones are completely absent still, and the impact that's going to have on the recovery and the pace of the recovery. So I'll turn back to Mark for the next.
Great.
section.
Thank you, Cindy. Very, very interesting and informative. Jan was very kind to provide some up-to-the-minute information on their weekly data, which, Jan, I'd like you to get into now. But before doing that, I'm still not sure I fully understand the latest acronym that STR has come up with, that being TRI. So could you explain that to me, and then tell us what you're seeing, and then we'll look at some of the weekly data.
Sorry. The standard STR way of looking at the world has always been that we look at the occupancy of the rooms available, which is not rocket science, you know, and it's not really a bad way of looking at the world, except in this world, because there's so many temporary closed rooms. So we get the question a lot, hey, your occupancy is really sort of overstating the reality. If you took into consideration all rooms, the occupancy would drop, right? Because the denominator goes up. It's like, yeah, that's true. That's not right or wrong. We can, of course, provide both views. So what we're doing here is we're showing on the one side the standard way of looking at the world, which is the lighter blue number. And for example, for luxury hotels in the United States in July, we said that occupancy was 34.2%. And that is a good number if you're in the market, and we're doing this obviously by market, by sub-market, we can do it for any cut that you want. If you're competing with other existing open hotels, you probably want that number. But then if you are, you know, a brand or an investor or a real estate advisor or broker, and you're interested in, hey, what does this look like when we take all rooms, total rooms, into consideration? Can you do the math too? The answer is yes. So then if we do that for luxury hotels, the occupancy drops to 29%. The difference, the percent change between those two numbers has to mathematically be, in a associated headline, the supply percent difference. So what that implies is that in July, 15.3% of luxury rooms were closed. The number is even more pronounced for upper upscale hotels, the big, large meeting boxes, the Marriotts, the Hiltons, the Hyatts, the Gaylords of the world, you know, where 16% of rooms were temporarily or maybe permanently, we'll see, closed. You know, I hope it's not permanent, but there's definitely a large number of rooms that are temporarily closed. We take those into consideration, the occupancy obviously drops. So this chart just basically shows you that on the upper end of the market, sorry, at the lower end of the market, the upper part of the chart, for economy type properties, basically all rooms were open in July. Like the occupancy is basically the same, it's only minus 0.9% different. The occupancy is the same, implying that there is no supply difference, implying that there are very few temporary closed properties. For luxury and upper upscale, very, very different picture.
So how about some of the weekly, current weekly numbers, Jan?
Yeah, so this is about as current as it gets, because I think the press release about this data came out 30 minutes ago. So I sent this to Mark last night. This is for last week ending the 12th, the Revpar percent change week over week, compared to the same week last year. And the point here is just to say, look, the lower end hotels are doing materially better than higher end hotels. Revpar declines on the upper end are much, much, much steeper, specifically for the full service boxes, the upper upscale hotels, large meeting room, large, you know, spa, large F&B offerings. Those hotels are hurting a lot, and luxury class hotels are hurting as well. If you're in the lower end of the market, you're doing quite a lot better, and that obviously has implications for profitability. And then if you look at on the next slide, the occupancy for the same week, you see a pattern that has been true since, call that April, you know, that upper mid-scale, and economy class properties have been able to attract the leisure drive to business and the leisure drive to traveler. And so their occupancies are basically over 50%. And you saw that the majority of those rooms are actually open. So this is arguably a true occupancy, no matter how you look at it, standard or TRI. On the higher end of the market, 2 out of 3 rooms are empty. 6 out of 10 rooms are empty for the luxury class. Plus, there's still a lot of rooms temporarily closed. So these are tough times on the full service upper end of the market.
Terrific, Jan. Again, thanks for sharing that up to the minute data with us. Very, very, very helpful. Cindy, I want to go back to you now and get some more of your thoughts in this whole area of channel management. That's key, obviously, to optimizing your bottom line performance. What are some of the trends that you're seeing, particularly within the luxury upper upscale channels?
Sure. So this will help kind of explain what's going on in the current environment and follow on to give a little bit more of the detail behind what Jan was saying. So if we look again at, this is the last, this is 2015 to 2019. So each bar represents a year, and the bar on the far right is the 2019 number. So if we look at the luxury and upper upscale, or the upper tier categories, the direct channels, which you can see on the left, brand.com is essentially the only one that's growing. If we look at the indirect channels, OTA, GDS, and FIT, really OTA is the only thing that's grown, and it hasn't grown dramatically at the upper end of the market. The group business is the thing that's so different for the rest, to the rest of the market, to the middle and the lower tier. Almost a third of the business is driven by group, which we're going to see shortly when I show you what's happening, the overall composition of the market. You'll see why the luxury and upper upscale hotels, the piece of the business that is essentially missing, that's causing all of this pain. But the good news, and I know you've heard so much bad news and there's so much negative things that we're saying, I'm going to give you something positive to think about. Pretty remarkable that at the upper end of the market, brand.com has had such a strong showing. So when we look at, it's more than twice the OTA volume, and that is, really stronger than any other category, and a really dominant amount of business, and having grown substantially faster than the OTA business. So for the last 5 years, the growth of brand.com, almost 5% versus the OTA 1.5%. So that is a really positive thing in a sea of all these bad things. But I'm going to get to some of the negative things that are the short-term points around COVID. With my next slide, you'll see that when we actually look at the 2019 Revpar, and we actually cast that as COPE Revpar, which is net of all expenses. So this is really contribution to operating profit and expense. So it's your netted down Revpar 142.73. And when we say, well, what actually comprised that? Like, what are the building blocks of that 142.73? And what we see is that the first 5 rate categories, group, corporate, rack bar, OTA, and promotion, which is also for the branded hotels, includes a loyalty member rate business, they constitute 81% of the Revpar, meaning of that 142, 80% of it comes from those 5 categories. The really negative thing because of COVID is that the group and corporate business has gone away. That is 45% of the Revpar. So until that comes back, there's a gaping hole, or there's like a big missing gap in the business. And that amount, that kind of $64 roughly of the 142, until that business starts to come back. And I think when it comes back, it'll come back strongly. But while it's not there, it's really hard to replace it. So this is kind of the picture of what's going on, and the reason for what Jan described, where the upper upscale and the luxury hotels are kind of hurting. It's because they depended, almost half their business is just absent. So when it comes back, it'll be great, but it's not like they can go and find something else. So when I show you the patterns by rate category, you'll start understanding what the hotels have done to compensate. So my next picture will be an overall picture of the pattern of business. I'm just showing you from the beginning of May until the week of the 4th of September. The red line is average rate and the blue line is occupancy. We actually calculate occupancy based on all properties, open or closed. We don't have two ways we're doing it. It's just all hotels, whether you're open or closed. The week of September 4th, we were at a 41% occupancy. And just to give you some context, the worst week since COVID happened was, I think, the week of April 10th or 15th, somewhere in there. Occupancy across the US was down 77%. Now, as of September 4th, we were down 33.9%. It sounds awful, but it's way better than 77. Average rate was down at its worst, 43%. As of September 4th, we're only down 24%. I know that sounds terrible, but it's still, and the reason is not because people dropped their rates. The reason is because the mix of business changed, and a lot of the higher rated business is just not there. So if we move into some of the specifics around this, I'm going to show you by rate category. And if you pay attention to the red line is OTA, the green line is loyalty member rate and promotion. And these are essentially the only rate categories growing. Revpar is either declining or flat. That's the pink line. The blue line is group, which for those in the luxury segment, I know this is a sad tale. It's not a happy story, but group is not. It's either flat or declining. And the only spikes we've seen, which you'll see when I get to the luxury slide, is really COVID-related business. So it isn't sustainable, normal group business. It's anomalous business that just came because there's healthcare providers or first responders or some other reason that the hotel got used. So if we look at the overall US, we can see, oh, can we go back, Mark?
Oh, yeah, sorry.
So if we look at the overall US, we can see that the OTAs have a bit of an edge. So they're the ones that are growing. They're growing slightly, but it's the only growth that we're seeing. And they have a slight edge over the loyalty member rate and promotion business. For those with loyalty programs, it's loyalty member rate. For those who have their own promotional, book direct, and other kind of programs, it's included in one rate category. So we see that in general, the OTAs have an advantage. But once we get into, I'm going to walk you through because there's big differences by chain scale. So the next slide, which is luxury, is going to show a much larger gap. The red line is considerably above the green line, meaning that OTA is considerably stronger and has been, the gap is widening to the loyalty member rate business. The group, which is, as I told you, has kind of up and down direction, and the earlier dates are largely related to COVID group business, but the core group business is not growing. And Revpar, which is the pink line, is flat, hasn't grown at all. The gray line is everything else, which is corporate, AAA, advanced purchase, government, all of the other kind of business. So we can see that in the absence of group and corporate, which is that 45% of the business, the OTAs have definitely taken an upper hand, because you saw in the totals, OTA did not play such a strong role in the luxury segment at all, but now it's going to play a stronger role because there's no other faucets running and you got kind of limits in what you can get for business. So if we look just in contrast at the upper upscale, which is the next slide, I'm sorry, contrast just to show upper upscale looks a lot like luxury, not quite as big a gap. But if we look at the upscale business, and upscale would be like a Courtyard or Hilton Garden Inn, you can see that the green and the red line, you can hardly tell them apart. They're running neck and neck like a horse race. And the Revpar business, which is the pink line, is declining. So the only thing growing is the loyalty member rate and promotion business and the OTA. And we've seen even an upper mid-scale, which Jan had pointed out, that's another area that's doing a lot better. It's because they're getting the loyalty member rate and promotion business actually is exceeding the OTA business. So I can tell you that in 9/11, the OTA business in 2002 spiked 100%. In 2010, after the 09 recession, OTA business spiked 30%. This time around, the loyalty member rate, promotion, and book direct business is actually giving the OTAs a run for their money, which is really encouraging. So again, I'm looking for good news here. That's good news. because that business is now being diverted and it's not completely going into the third-party areas. So if we then skip over, which I know group business, there's a lot of interest in. We collect data from about 1,500 hotels, their group pickup and cancellations, a lot of large group boxes. We saw a little bit of an improvement in group. This is pickup net of cancellations. We saw a little bit of a pickup in September. There were just a few big box hotels, some very large ones that got a few university dorm contracts that gave us a spike, but otherwise, essentially they're negative. They're net of cancellations. They're still not picking up very much, and we're now moving into 21. There's too many restrictions around meetings and groups, and it's just not going to start up yet. It's just, we do not see it. So, you know, that's sort of the story. I don't think that's a surprise for anyone. And then one of the other data points that I wanted to share in terms of future data is the next slide, which is airline purchases. So this is airline bookings through December 31st. These are future bookings, and being able to look at different markets. I just picked 5 as an example. Where it's still relatively flat. We don't have, Dallas got a little bit of a spike. We had Atlanta, we were tracking, that had a little bit of a spike, but essentially the airline bookings haven't started up. So again, that goes to the kind of corporate and group market as well. There's just not, no action there. So that kind of gives a picture, I think, a little bit on the luxury side of what's happening and the reasons behind some of the down occupancies. But once this business starts up, the whole picture will start changing again. Thank you, Mark, back to you.
Yeah, terrific, Cindy, that's really great. Hey, Jan, virtually nobody saw this coming in terms of the contraction, the depth of the contraction. I know you were saying a year ago, I think CBRE was saying a year ago, others, that clearly there was a slowdown playing itself out, but again, nobody anticipated where we are today a year ago. And as a consequence, there was various volumes of development construction activity. And we've seen in past cycles that the building cycle tends to lag the business cycle. So what's happening on the development side today, and what are you seeing?
Yeah, so just for the record, I wrote in December of 2019 an article on HNN saying 5 things to worry about for the next decade. I predicted a recession in the next 10 years. I had no idea that it would come, 90 days later. But so,
but hey, Jan, you know what they say about the blind squirrel, though, right?
So let me stick to data I can actually talk about.
Just kidding.
So this is glass half full, good news or bad news, depending on which side of the development cycle you are on. What we're looking at here is the total number of rooms in construction for the United States. And it is clear that the US is shifting or has already shifted into a limited service environment, right? 7 out of 10 rooms in the construction pipeline are limited service, upscale on down. And there are not a whole lot of full service hotels being built. So if you're an existing full service operator or owner, you might say, hey, that's good. There's a lot less competition for me to deal with in the future. The truth is, on the other side, though, that the development money and the brand support is clearly behind the limited service properties. It's very, very hard to get the big boxes done. It can be done, probably also fair to point out that a lot of these, I want to say 2,500 or 3,000 of those rooms, luxury rooms, are in Vegas. So Vegas is back on the pipeline map.
Got it. Okay, thank you, Jan. Okay, Jamie, turning back to you, walk us through your current thinking as it relates to location types and who's been outperforming the industry averages and so forth, with a specifically, obviously, looking at the luxury segment. What trends are you seeing?
Yeah, so we've been looking at new data from Calibri on not only location type, but location type by chain class. So this is looking at the different location categories for just luxury hotels. And there are some bright spots, and maybe along with what you would expect of and where the demand is going is where you can spread out the most. So in rural, small town resort destinations. So getting a sense of what type of hotels are these, I looked into what were categorized in. It's hotels like the Ritz-Carlton, Reynolds, LA Coney here in Georgia. It's luxury properties in the mountains of Colorado, Montana, and Wyoming. So spots where you have a lot of space to spread out. Next slide. And this gets into as we're thinking about and forecasting the luxury sector. So as Cindy mentioned, a good part of luxury Revpar in demand is related to GDS and group business, more so than any other chain scale, which in certain parts of the cycle is a good thing. Right now, it's not. And like Cindy said, as it's played out since July, we've actually seen a lower and lower share of overall demand through 2020 go towards group and GDS demand. And that's going to play out into the slower recovery in our forecast. The other is just, and to further make the point on the next slide, breaking out luxury occupancy between weekend and weekday. And you can see normally we see a gap of anywhere from, and it's generally 3 to 5% weekend higher occupancy than weekday for luxury properties. Now we're over 10% higher on the weekends than weekday. So it clearly points to it's going to take some time for luxury to get back. The next slide shows our current forecast for specifically the luxury chain scale, which has broadly getting demand back up to long run average by 2024, ADR roughly the same time. And this is our baseline outlook, which calls for a relatively rapid recovery and in Revpar getting back to 2019 levels by 2025. Where we, and I'd like to point out is we do expect a further decline in ADR in 2021. And that surprises people sometimes when I say it. But it's more, not necessarily that we're going to see more discounting in 2021. It's that the high rates generated in January and February, especially in the ski and resort locations, make up such a great percent of overall revenue generated in 2020 that when we don't get that in 2021 and only maybe a slight increase the rest of the year, it causes a rate decline on balance for 2021 for the luxury segment. That doesn't mean to say we don't think rates for March and beyond will see slight increases as the industry begins to recover. The next slide shows luxury in relation to the other property types, other chain scales, and you see it is in this, let's say, second worst. We're expecting to get back, as I said, by 2025, and slightly ahead of upper upscale, which we'll see how that plays out. The last slide I have just breaks it out on our scenarios. So we do 5 different scenarios. I've shown 4 here of if we get an upside, sort of things get back to normal quicker than expected. We get a vaccine maybe in Q4 this year. And then the downside anticipates further recession, further pain. And it does further push out our recovery. I would say across all scenarios, we see occupancy get back in 2023, 2024. It's just how deep of a recession do we see causes how much discounting to get guests back into hotels. And in the downside and severe downside scenarios, that could push the recovery back to 2026, 2027. So with that, I'll pass it back to you, Mark.
Got it. Thank you, Jamie. And Jan, take a minute if you would. And what's STR's most recent forecast for the luxury segment as we head into 2021?
Yeah, so I can't stress enough what Cindy said and what Jamie just said, that what we're seeing right now is not discounting, it's mixture. You know, it is the higher rated group, the higher rated incentive group, and with high occupancies come often, you know, very elevated corporate rates on the transient side. That's not there, you know. So what you're seeing is leisure, and the leisure travelers paying what they're paying. We're not seeing a whole lot of discounting going on there necessarily. So just keep that in mind when you see these numbers. They are jarring, but that does not mean that there's a revenue manager actively fiddling with the knobs and, you know, cutting right. So we're basically suggesting exactly what Jamie had said. We're a little bit more bearish on the ADR outlook. I think, Jamie, you had that basically coming back in 2024, sort of with the room demand. We're saying, you know, the decreases in ADR that we're seeing going forward is going to be with us for a while. So we think that might be 2025. But that said, you know, the percent changes are sort of a little mind-boggling, you know, but it's going to go down a lot and then back up a lot off a much smaller base. And you see the numbers here. We're basically saying that the occupancies are going to double for next year off a very small base. But so I think that the tenor is basically the same with what CBRE and Jamie are proposing.
Got it. Okay, thank you, Jan. I had asked Cindy to pretend for a moment that I was a director of sales or a revenue manager at a hotel, and Cindy, tell me what it is I should be thinking right now as we head into 2021. So Cindy, I'd like you to kind of share some of those thoughts, if you would, for the group.
Sure. Thank you very much. So as we all just finished talking about, it's not, the rates are down because of mix. This is not a time to cut rates. So it doesn't mean that the rates, you know, for different segments would be different, and weekend and leisure is going to be different than corporate and group. I have seen hotels over the years that I've been in the industry, running hotels and as a consultant, cut rates in one day, and it took them 10 years to recover it. Now is not a time to cut rates, but it's going to be a tough road to hoe in the luxury segment, because this business that you've counted on for, you know, 45% of your business is going to be gone for a while and isn't going to come back for, you know, 6, 12, 18 months, and it'll come back soon. So what I would say is you're going to have, you may be competing down market, and the next, Mark, if you want to just bring on the next line, I wouldn't feel that you're so powerless in your situation. You have some power over your demand. You don't just take anything that comes along. And it's not like you can, I'm saying you should be selective. It's that you need to proactively look at your choices between putting your money and your time into direct campaigns and direct initiatives versus third party. You can't afford to do everything, and you're far better off doing things, whatever you can do to get direct business. It's twice as profitable and will contribute to cash flow. So if you're going to put time and money into something, I wouldn't just succumb and take any OTA program that's out there or a third-party program. I would really try to do whatever you can on direct business. The other phenomenon that we're seeing is, because of this interest in contactless travel, things like mobile check-in and keyless entry, and, or, you know, digital key or whatever people call it, choose your own room. There's a big interest in that, and that's created a bias for direct booking. So to the extent that you can offer some of these services to enhance the experience in terms of being contactless, you will enhance your direct business, because in order to get those, you have to book directly, which is a lot of the reason why those loyalty member rate programs have actually been sustainable. I wasn't sure what would happen with the pandemic. I wasn't sure if they would be sustained. The industry had almost 4 years of experience at running these book direct programs, and I didn't know if they would stick or be sustainable, but they have been. So whether you're an independent or a small chain, or you're part of a big chain, the loyalty and the book direct campaigns, whatever form or flavor it takes in your world, consumers like them, and they like them because of the other benefits, not just because of counting points. So just to summarize, what I would suggest to any director of sales, general manager, revenue manager, understand the faucets that are flowing in your market. Know the rate categories, know the channels, understand what you have now, understand what's predicted, and plan for an optimal mix, knowing that some of that business is just not flowing yet. Think about your Revpar and your average rate on a net basis. Luxury hotels pay a huge percentage for cost of acquisition. So really think hard about that mix of business, because you lop off a whole bunch of it when you start thinking about cost of acquisition. So think about what you're taking, go for the direct business. And when you monitor and benchmark yourself, look at it by rate category and channel, so that the efforts that you're taking, you can actually see how you have moved the needle and how you've gained share. It's a different way of thinking about it, but in today's world where the recovery is so uneven, understanding the composition of your Revpar is far more important than just a total number. And in the luxury segment, even more so, because the nature of your business is going to be changed so much for the next 12 to 18 months. Thank you. I'll turn back to Mark to close out.
Yeah, thank you. Thank you, Cindy. The last area, Jamie, I want to toss this over to you. Our panelists, myself, we've spent the bulk of our career focusing on, generally speaking, two areas: understanding the operation sides of the business, what kind of expenses are going to be needed to earn the revenues that you're chasing, so forth. But the other side is we spend an awful lot of time with owners of hotel real estate, and so I think it's always good for both perspectives, obviously, to understand what each world is like. So, Jamie, if you give us your current thinking as what's happening to property values, and you know, that's in the head of owners, obviously, and how that might be affecting things.
Yeah, and it is a really hard question today, with most luxury hotels and losing money on operations. Not a lot of transactions out there to point to. So what we've been doing is looking to our valuation professionals, and they've done over 100 valuation assignments since the onset of COVID of properties that they had valued in the previous year in 2019. And then we're able to compare what that value loss is, not necessarily on a stabilized basis, but just as value as of today. And here we see a wide range, similar to the wide range in performance, and anywhere from 5 to 35% declines in values, which does match up with some of the transactions that we've seen actually trade. We've got one coming to market soon, or closing soon, in a major market. Extended stay hotel was only less than 10% off of value, off of 2019 value. So there is a lot of pain out there. We are seeing a lot of discounting, or at least perceived discounting. And as the bid-ask spread for values of what owners are willing to take and what buyers are willing to pay narrows, I expect we will see transactions start happening and averaging probably, as it looks now, around 20% off of 2019 values.
Good, thank you, Jamie. So obviously a lot of pain, deep pain, and that's clearly going to affect, you know, how capital is going to be invested, how it's going to be spent going forward, whether that's in renovating, repositioning hotels, buying assets, etc. I'm going to take the liberty, since I have the clicker here, to ask each of you one more question, and Chris, then we'll turn it back over to you if I've got the time right. But and Jan, let's start with you. And all three of you know me. I'm an optimist at heart. It's the glass is just about always half full, and if not better. But so in that spirit, perhaps, what good comes out of the pandemic for our industry? What's going to be better than it otherwise would have been if we had never gone through this? Do you have some thoughts on that, Jan?
I think sort of holistically, what we're realizing is what matters most is family, right? And who we want to be with when things get tough as family. So I think multi-generational travel will really, really, really be a thing that stays here and will propel us forward, you know, and that's where luxury and high-end resorts with independent, freestanding villas or connecting rooms that you can make your own quote-unquote bubble, really have a leg up. So that to me is something, and I know that from my father-in-law, who kind of cares about me, but he really cares about his grandchildren. It's like, look, you quarantine, we all get together, and he pays for everything in a nice environment. I think we will see a lot more of that.
Very interesting. Makes a whole lot of sense. Cindy, from your perspective, what's going to be better than it otherwise would have been?
So I actually also am an optimist, and we'd had 10 years running of growth, and I think there was a little bit of everybody being a little bit fat and happy, and I think we were due to have a reset. What I expect, and of course my focus is so much more on customer acquisition and the revenue generation side of the business. I think we're going to really fine tune our ability to acquire customers, really think about the cost associated with it. Just things like organizationally, where we've had silos of revenue management and sales and digital, we're going to migrate those to commercial teams where it's much more integrated and much more efficient. I already see that with a lot of management companies and brand teams where they're creating a commercial umbrella, and then they just have specialists. Instead of a revenue analyst, it might be a commercial analyst who then looks at Google Analytics as well as sales deployment as well as pricing. So I think we're going to get much more efficient in the commercial acquisition of business. And I think it's hard to make those changes when you're not forced to. And unfortunately, we're being forced to. But I think in the end, we're going to come out the other side a much leaner, meaner, and much more efficient revenue generation machine. And I think we need it because we don't want capital to exit the hotel industry. We want it to be a healthy environment. We want there to be enough profit and cash flow to be an attractive place to put money relative to other real estate assets and asset classes. So I think that this will make a really positive impact on the overall operation. And I'm sure there'll be operational efficiencies with robotics and other kind of things on the operating side of the business. But I think it's going to force us to really scrutinize everything we're doing, and we will come out better as a result of that.
Got it. Makes sense. Thank you, Cindy. And Jamie, up to you. You'll clean it up, and then we'll turn it over to Chris.
Yeah, and I maybe take a contrarian view on this, and we've been doing a lot of thinking about what this environment, and we're all sitting at our houses now, and we expect a good percentage of the population to be working from home, maybe long-term, even once offices reopen. And I think that actually has a long-term benefit to group travel of if you are working at your house, out of your house, there's going to be a much stronger desire to go to conferences, go to conventions, go and meet with colleagues. If you're working outside of the office, and the most logical spot to meet with your coworkers is back in the cities, back in hotels, which can offer you the space to do that. So I'm long on group travel, and I think it's going to come back stronger than ever.
Terrific. So you're in the glass half full camp then, huh?
Always.
There you go. Okay, Jan, Cindy, Jamie, thank you for your insights. Great as always. And Chris, with that, I'll turn it back over to you.
Great, thank you, Mark, and my thanks also to Jan, Cindy, and Jamie. Thank you to everyone listening in. Hopefully you found the webinar to be of value, and if so, please share the recording, and you can find additional recordings of the past webinars on the ILHA's website, which is theilha.com under events. So we encourage you to have a look, see how you can get involved with the ILHA and share your expertise, network, grow your own business. Then I think we also want to mention the Inspire conference, which is the ILHA signature event. This year it's a virtual conference taking place on the 14th and 15th of December. And you should, again, go to theilha.com, register for a free pass, and evaluate all the content. Should be a great event. Thank you.